Thank you. All right. So good morning, everyone. My name is Hannah Richards. I'm investment management associate at SYGNUS Capital, the investment manager for SYGNUS Credit. Today, we'll be walking through the Q1 results as at September 30, 2022 for SYGNUS Credit Investments. I'll be joined today by Jason Morris, who's the Chief Investment Officer. And he will be able to walk us through detail of the result that would have been released today at the Jamaica Stock Exchange. As per usual, you're able to send your question through the Q&A button. We will have a Q&A section towards the end of the presentation where we'll address any questions sent. You can also send your questions after the earnings call via email and they'll be addressed accordingly. Again, just to walk us through, as a reminder, the full earnings releases on the financial statements are on the Jamaica Stock Exchange website as well as on the SYGNUS website as well. And you guys can read those reports, download those reports, and you can read them in conjunction with this earnings call. They also can be found on our YouTube page after the earnings call and also on our website. I'll invite Jason to walk us through today's presentation.
All right, thanks, Horton. Can you hear me?
Yeah, we're hearing you loud and clear.
Okay, good morning, everyone. Welcome. Hope you all had a fantastic weekend. And if you didn't, hope that this weekend you'll have a fantastic weekend. Okay, so jumping right into the results for Q1, SCI reported a record for total investment income, which is, top line revenues, net investment income, which is core earnings, and net profit. The total investment income was 2.27 million, up 24.7%. Net investment income was 1.37 million, up 21.9%. And net profit was 1.63 million, up 8%. EPS, or earnings per share, US 28 cents versus 0.28 cents versus 0.25 cents for the same quarter last year. And on a diluted basis, that came out to be 0.27 US cents. The company would have, during the quarter, following the annual audit, would have declared a dividend of 0.00262, which would have been paid on October 14th, and everyone who's an investor and was a shareholder on September 30th should have received those dividends long ago. That dividend amounted to 1.55 million US, the same as has been paid for about three dividend payments in a row now. In terms of, credit rating during the quarter, SCI would have received an upgrade from CARICRIS, the credit rating agency, the regional credit rating agency, where SCI is now investment grade, and the Caribbean and the regional rating scale carry BBB minus with a stable outlook. And on the national rating scale, Jamaican rating scale would be BBB plus, also with a stable outlook. In terms of, the trajectory of, revenues and core earnings, you can see that on a Q1 quarterly basis that SCI doesn't have a problem growing. It has been growing at a compounded annual growth rate of 67.5% since inception. And for core earnings, that's 60.1%. So pretty good growth rate, given how young the company still is. Now I want to go through the financial results a little bit more because I need to explain a few things that are happening with the financial statement. And as we go through consecutive quarters in this year, you'll see some small changes start to creep in, such as additional revenue lines, etc. So I think for both Q3 last year and the financial year end, those earnings call, we would have, spoken about some of what we are about to speak about now. So if you look at interest income and interest expense, you can see that interest income grew, but interest expense grew substantially more than interest income. So the question is, why is this? Well, if you recall, last year, this time, SCI's debt to equity ratio was about 0.25 times, and now it's about 0.87 times. So the amount of debt that SCI would have used would have gone up. And we would have been speaking to the fact that because SCI has is lowly leveraged, then we are going to increase use of debt, which obviously increases return to shareholders. But as would have been pointed out before, if you look at net interest income, you have 1.56 million this quarter versus 1.823 million same time last quarter. And the main reason for this is that we would have used roughly 22 million US to finance the acquisition of Accrescent Financial Corporation. But Accrescent Financial Corporation in Puerto Rico isn't consolidated all the way up into SCI. So while there's an interest expense related to the acquisition, there's no interest income coming from that acquisition. So what we have instead is what we are calling Puerto Rico Credit Fund Investment Income, which clearly is not interest income. It's basically the net benefit that is being generated from the investment in Puerto Rico. So you're gonna have that kind of skewed factor for I guess the short term until the portfolio value builds up substantially to offset that that static cost, so to speak, for the financing of the Puerto Rico Credit Fund. So as far as the Puerto Rico Credit Fund investment income goes, you can see that last year we would not have had that on the income statement, and this year we are generating 693.7 thousand from the net value. Now this amount, if you look at the financial statements, is actually rolled up under fair value, and this is because this investment does not meet the accounting standards to be consolidated in terms of the three metrics that we have to utilize to say whether or not it has full control and therefore should be consolidated. And so this is how we have to bring this item on a go-forward basis, which we break out for you in the MD&A and in this chart on a go-forward basis. So when you take the quote-unquote gap that exists for net interest income and add the Puerto Rico Credit Fund investment income, total investment income, or core revenues, would be 2.27 versus 1.8 last year, as I would have explained prior. Now, one of the things that you're going to notice going forward as well is, SCI has already started the process of enhancing its revenue stream. So over the last 5 years, or up to the end of the financial year end, SCI mainly would have been generating revenues from net interest income, right? Just the assets on your balance sheet, you earn an interest on it, and then you offset that against interest expense that you use to finance the portfolio using leverage. But on a go-forward basis, other revenue lines such as participation and commitment fees and maybe some other revenue line is gonna start being reflected as part of core revenues or total investment income as a business expands. So I guess, in the second quarter earnings call, when those start to show up, we'll explain what those are. I'm not saying this to say that, what we would have been speaking about 2 or so quarters ago in terms of looking to scale the business, looking to bring additional revenue lines into the business to expand it so that the solid base that the business already has in terms of net interest income will now be complemented with other revenue lines to diversify quote unquote the revenue stream and drive earnings per share, ROE, etc. So operating expenses would have been higher than last year, mainly driven by obviously higher assets under management, but also for the financial year and audit would have had some one-off consultancy fees that would have had to pay, professional fees. I think that amounted to maybe 65,000 greater than it was last year. So now go for the quarters coming, we shouldn't see that recurrence because those were really dealing with year-end financials. Fair value gains, less than last year, obviously, based on what's happening with the value of the portfolio and what's happening in the market. But the rest of this slide I would have gone through on the first slide already, so I can move on to the next. Efficiency and management expense ratios. So nothing to write home about here. We are within the threshold for operating expenses to total investment income. We're also within the threshold for management expense ratio, which are key ratios to watch. If these are consistently out of whack, then it means that every dollar of revenue generated, some is leaking out. And that's something that we have committed to maintain global best practice to ensure that the company is operating extremely efficiently. Balance sheet summary. Shareholders' equity continues to creep up as earnings continue to improve, now at 67.54 million. After accounting for the dividends that would have been paid in October. Total assets is now at a record 142.4 million, up 51.7% versus last year. Of course, this includes the investment in the Puerto Rico Credit Fund, which is as a result of the 93.66% acquisition of Accent Financial Corporation in February of this year. In terms of balance sheet KPIs, SCI remains a pretty lowly leveraged company. Debt to total assets is 0.44 times, asset coverage ratio 2.19 times, and asset coverage ratio is very important because what it basically says, if you have a very severe economic situation, can we discount those assets by 50%, sell them off, and still repay all our debts? And the answer to that question is absolutely yes. And you would have seen the improvement in the credit rating that SCI would have gotten during the quarter. Debt to equity, still pretty unlevered. Of course, as we go through time, we intend to increase leverage to deploy that capital into higher earning assets. And just including another statistic that perhaps on a go-forward basis we'll start reporting on and talking about, which is the fair value asset spread, which is basically dealing with what's the yield on our assets versus the cost of our leverage, our cost of our financing of our debt. So our target is really to generate more than 500 basis points. At the moment, we're kind of substantially above that, but this won't really last for very long because we're going to reprice a portion of our debt portfolio. So we expect this to come back closer to, say, in the 600 basis point region. But clearly what's happening here is as the assets on the portfolio as new assets coming on the portfolio are being priced at the higher yields, but the debt that we have so far was locked in from, I think, January, February, March at below 6%. So the portfolio obviously is getting that benefit from a widening spread until we do that refinancing of maturing assets coming through in December. Now looking at portfolio activity, investment in portfolio companies, now 100.5 million, up 18.2%. When you exclude the investment in the Puerto Rico Credit Fund, of course, if you include that, then we're talking about 130 million US. Portfolio companies remain at 33 year over year, but this is up 3 versus the financial year end. So what has happened over the intervening 12 months is that we have exited some portfolio companies and then reinvest that money into new portfolio companies at higher yields. New investment commitments in the quarter, 6.4 million. But the origination during the quarter was actually, I think, 17 million or thereabouts, because 15 million of this amount was related to we have an inventory and receivables financing program, which we have been investing in these type of assets for 3-4 years, but on a small scale. Expand those facilities substantially. Revolving facility, so it can actually expand up to 25 million US. That's just one facility. Subsequent to the quarter would have also originated 2 other similar type of facilities, which we would have the first drawdown on those facilities will have actually occurred. So we'll speak more about those in the next quarter report. In terms of fair value yields, 14% versus 12.9%. So it's inching up based on the nature of the market. The tenor, 1.7 years. Of course, you know that SCI can invest up to 5 years. And on an exceptional basis, we can go up to 7. But given how low yields have been since SCI started investment 5.25 years ago, we kind of kept the portfolio tenor very short. So as we are going through a period where interest rates are rising, clearly that's advantageous to a portfolio that where the average maturity is only 1.7 years, right? Because what that does is that you have reinvestment opportunities, because as you roll off maturing investments, what you're gonna do is roll them into much higher investment yields. In terms of dry powder, we had 5.7 million on the balance sheet, and we also had 3.4 million in undrawn credit lines. Obviously, we would have used some of that post the end of the quarter because I spoke about some inventory and receivables financing facilities that we would have originated, and the first drawdown on those would have occurred post quarter end. We also, have advanced discussions with our international financial partners to access substantial revolving and other type of credit facilities. They continue to go through their due diligence, and they're also reviewing the various type of structures that we could utilize to access these facilities once we have a deal on the table. Also, we would have mentioned in the last quarter report, we would have had a 14.7 million pref share, that the all-in cost for it would have been double digit. During the quarter, however, SCI, after receiving an upgrade on its credit rating, we entered some discussions where we were able to kind of nail down cheaper cost financing. And so what we did is effectively, given how the markets were moving in terms of the cost for preference share, which is effectively equity cost, equity financing, we chose to only utilize a small portion of the pref share, just a tad under 5 million, and replacing the remainder, which is effectively 10 million, with cheaper debt facility from 2 investors that will save us about 300 basis points. So that's something good that we have done in terms of trying to pivot given the market conditions. In terms of pipeline, we already have $20 million worth of approved transactions that are at various stages of documentation and process to draw down on. In terms of near-term pipeline, we have substantial above $100 million of pipeline across the English and Dutch-speaking Caribbean. In fact, in this quarter alone, I think we have more assets. We have more pipeline assets than financing that we have in the bank account at the moment. But that's something that we're working to solve with the drawdowns that we spoke about, and obviously with other short-term financing facilities that we can utilize. So the big story here is that growth is not a problem as far as origination and opportunities that we can deploy capital into, and while providing a good downside protection to ensure that we don't have any crystallization of charge-offs that will hurt us substantially. In terms of Accent in Puerto Rico, the average private credit portfolio year to date is 72 million, so it has fluctuated around that figure because, as you know, in their neck of the woods, their portfolio is twofold. You have what's on the balance sheet, and then you have that generates net interest income, and then you have what is in true sales, which you sell those off the balance sheet and generate upfront gains. So during the quarter, they would have originated 11.7 million, which would have been financed. But in terms of year to date, their year end has not been adjusted to SCI as yet. So they are still operating with a December year end, which obviously is going to change as we conclude the full integration. So year to date, they are at their highest all-time high in terms of originations and deployment, in excess of 45 million for the first 9 months. Their yield is just a tad over 9.5%, and their tenor is just under 3 years. Just to provide some additional update on Accrescent, this would have come out in the news where they would have secured 34.8 million in financing from 4 global impact investing partners. For those of you who may not be aware of what impact investing is, it's basically investing in a manner that you can, measure the quote unquote impact of what of how your investment affects either the environment or any type of environment, social or governance structure. So you might be targeting female entrepreneurs from a social perspective, or looking at sustainable housing or sustainable farming practices or healthcare. Targeting small and medium-sized companies. Of course, Accrescent, as you know, finances small and middle market companies in Puerto Rico and some other Spanish-speaking Caribbean territories, but primarily in Puerto Rico at the moment. That's what we're focusing on. So these 4 impact investing partners, Blue Earth Capital, Senarth, Calvert Impact Capital, Community Development Venture Capital Alliance, these are global impact investing experts. A couple of them have partnered with Accrescent Financial Corporation before, because Accrescent actually has 2 off-balance sheet funds. One of them, Lift One, which is a Puerto Rico Business Impact Fund, would have deployed over 31.5 million US over the last 2-3 years in 154 financing to more than 80 businesses, affecting more than 16,000 jobs. So the track record that they generated on that first impact investing fund, they were able to go and get additional monies from these impact investing partners and also bring new investors into the fold for their second impact investing fund called Lift 2. So Accrescent continues to show why it's a key strategic partner that SCI would have partnered with via that acquisition, because it brings to SCI a dearth of diversification and exposure to investment strategies and access to international investors and financing partners that SCI would have struggled to access on its own. So as we go through this integration and push very hard to expand and grow the business, we learn more and more about this in subsequent financial quarterly reports. But this is very good because the Caribbean region, the English and Dutch-speaking Caribbean, is ripe for this type of investing. So we'll speak more about this in future quarters. From a risk management perspective, non-performing investment ratio would have fallen substantially relative to what was reported last year. And from a stage 3 asset, would have now moved on to 2 from 3, and this is primarily being driven by the fact that in the financial year end audited results, we would have taken the full charge off on the Cayman investment company for 3.85 million, pending court case for a petition to wind up the company if it weren't able to actually access financing to refinance all its debt. So the court case actually occurred in mid-October, and the company unfortunately was unable to raise the capital to refinance the debt, and so the court ordered for the company to be wound up. And so effectively that company is wound up. So where we are in that process now is to proceed with our legal counsel, etc., to explore all the avenues to recover any residual investment from the asset after it's being wound up, if there is any. At this stage, we're not really holding out hope for any substantial recovery, if there's any. This is our first charge off and represents about 0.35% on an annualized basis. On over 200 and, well, at this stage, it's going to be about 225 million of capital that SCI would have deployed. So we'll continue to follow up on that. But at the moment, I can say that SCI's balance sheet after that first charge off looks a lot cleaner with a substantially lower non-performing investment ratio that are properly collateralized and protected. One of those assets, which is an asset that is actually was wound up, was declared bankruptcy, and is actually we have a 1 million exposure in that, which we would have spoken to in a number of quarters before. We have external collateral. The underlying asset was actually sold to a buyer. The last report on that was that last time reported that the then trustee reported that the monies from this proceeds of sale was more than enough to cover all outstanding debts. However, we now have a new trustee at the helm who kind of see fit. So we are working with that new trustee to lay our claim because there is, as sometimes, these things go, they can be complicated at times. So effectively, we have external collateral that we can charge on, but our preference is to lay claim to the portfolio company itself, given that there is a sale and the proceeds of those sales are substantial enough to actually pay out all investors. So that's a process that we're working through with the new trustee. There are some legal things to work through there, so we'll continue to work through those and advise as you go through time. But we don't expect to lose money on that transaction. The long and short of the discussion. In terms of portfolio allocation by industry, would have expanded. So excluding the PRCF, would have expanded our investment allocation to a record 12 industries. The new industry would be health and sanitation services. Just a small ticket size. This is our first ever investment in this industry to a Jamaican middle market company. So, we continue to support Jamaican businesses despite Jamaican now being a smaller allocation overall. The chart on the right is showing the consolidated underlying portfolio in Puerto Rico, which is 21 industries, with the leading industries being construction, financial services, and hospitality at 14.6, 14.4, and 12.5% respectively. In terms of allocation by region, when you exclude the Puerto Rico underlying portfolio, Jamaica is the largest exposure at 39.6%, followed by St. Lucia at 17.4%, and then Bahamas at 14.1%. When you include the underlying portfolio investment, Puerto Rico investments, then Puerto Rico is 34.3%, Jamaica 25.2%, and St. Lucia at 11.1%. So we have very good regional diversification. Of course, would have mentioned in three other quarter reports that we effectively have 9 territories when you exclude Dominican Republic, Mexico, Panama, and Costa Rica, because those investments are actually ring-fenced and being closed out, of course. And at some future time, we may revisit expanding to those territories, but for now, for the next 12 months at least, we are focused squarely on Puerto Rico. Finally, in terms of strategic update, work in progress, AFC acquisition. The main update here is that phase 2 integration continues to proceed. With a wrapped up phase 1, which is the transfer of the fixed asset and the workforce in July. We are now expecting to wrap up phase 2. There are some legal issues that we're working through. So within another 2 or 3 months, well, maybe 1 or 2 months, we are hoping that we can advance this substantially to wrap up the integration process. Of course, we are continuing to scale the business, both on the impact investing front as well as the regular private credit investment front. In terms of SCI's growth path, we are still working through those revenue targets, which will provide an update at the AGM, 2022 AGM, which is scheduled for January. We do have sent out those invitations to our shareholders. Also, we'll explain there our new ROE and EPS targets. Dividends enhancement is an ongoing issue. Credit facilities, due diligence by investors is ongoing. Negotiations are advancing. Scaling of financing solutions for the English and Dutch Caribbean market outside of Puerto Rico would have done that during the quarter, expanded our inventory and receivables financing program to the extent where, in our pipeline, we are considering, I guess for the first time, 50 million plus type financing facilities. So we'll provide more information on that in our next quarterly report. In terms of one new item added, origination target. So if you would have noticed in the annual report, we would have said that we expect a minimum of 300 million US in originations over the next 3 years. So if you work out the math, that's about a minimum of 100 million per annum. And just to note that this 100 million per annum minimum, that's a minimum. This is not just going to be all assets coming on the balance sheet, right? This is also going to be assets that will be syndicated down or sold off. Well, let's use syndicated down, which means that SCI will generate upfront revenues from those, which will enhance top line total investment income, enhance earnings per share, enhance ROE, etc., which is something that we have been speaking about for about a year now. So this process is ongoing, and as we get access to the larger financing credit facilities, these strategies will be rolled out, and you'll see the impact on the financial statement. There are strategic partnerships. We have advanced this on multiple fronts, both from a SCI proper perspective as well as from Accrescent perspective, and partnerships with global institutional investors. All of these things, we spoke about them. We have been speaking about them for a year now, and you have been seeing the various announcements, and we are working on some that we can't announce. But rest assured that they are advancing, and they're advancing at scale with very large financing partners. Of course, Accrescent's ability to tap into very large impact investing partners who are willing to put down their capital based on the track record of Accrescent is very good, and is showing you that we are moving. And finally, the share buyback that I know everybody wants to speak about, we are advancing that process, and we'll provide an update, perhaps fittingly appropriate at the AGM. That's it for the presentations. We'll take questions.
All right, thank you for that, Jason. And again, so I recommend everyone just to submit your questions to the Q&A. We have received some questions throughout the presentation. One of the first is the dry powder that SCI has currently plus drawdowns from credit line does not match with the immediate pipeline. How do you seek to address this?
Very simply, we can tap into short-term financing sources based on what it is that we are financing. So for example, if you look at our inventory and receivables financing, if, for example, we are syndicating down a large part of that with co-investing partners, then we don't need to have all of that capital on the balance sheet, right? We can do a back-to-back transactions where we access a line, that line underwrites the facility, it's syndicated down, we book some upfront income, and then the line is paid out, and we just rinse and repeat. So we think we have enough capital at the moment to finance the stuff that we want to add to the balance sheet, and we think we have various ways to access to tap financing to tap investments that we want to do that we can generate upfront income on that isn't going to be held on the balance sheet.
All right.
So it's in a perverse way, it's a kind of a good problem to have, right? The problem you don't want to have is to not be able to have any pipeline to actually deploy capital in. So you have the capital, you have capital on your balance sheet, but you don't have any investment to deploy it. That's the real problem we want to avoid.
All right, thanks for that, Jason. So a question that came in was pertaining to the preference shares. So originally we had 14.7 million in preference shares, of which we raised about 4.7, and you have mentioned that we're looking to raise cheaper capital with a $10 million note. Is it that you're seeking to refinance part of the preference share through this new note? And when exactly would they expect this transaction to close?
To answer the last part first, we expect the transaction to close very shortly. for us to draw down on it very shortly in maybe a matter of weeks. In terms of the first part of the question, so we didn't actually go and raise. So when we looked at what was happening in the market, there are a lot of transactions coming out, and the cost for quote unquote, sub equity was 11%, 9%, 9.5%, 10%, running into double digits, right? And when we looked at what we wanted to do and how we wanted to do it, we felt it would behove us to actually, given that our credit rating was released at the back end of when we would have been trying to get as much financing, as much capital as possible under the pref share, that would make sense for us, since we are able to, since investors actually love SCI's debt, and our credit rating would have, enhanced our position to say this is a good credit to hold. Then what we basically decided to do is to say, hey, let's not chase down, trying to get in capital that is, very expensive based on how fast rates were moving up. For equity type financing, let's try and get, since our balance sheet is, not even at 1x leverage, let's see if we can tap in some short to medium term debt financing. And we went about and did that with a few investors who have agreed, and so we are just at the final stage of wrapping those up.
All right.
So in effect, the total amount of capital being raised hasn't really changed. It's just that we have pivoted, and we take a small amount of the pref, and we take a larger amount of what will be cheaper for us, save us about 300 basis points.
Thanks for that, Jason. The additional question we got was, in what form was the $35 million investment made by the Impact Investing Partners?
So the structure is really debt. That is in the form of debt. So basically, the impact funds are actually off-balance sheet investment vehicles. And so the way all these vehicles work, you have X amount of equities in the vehicles, and investors will come in and they put in their capital at a particular ratio to the amount of equity that is in the off-balance sheet financing vehicle. And then all of that combined capital can be deployed into various strategies, and the investors have their criteria that they're using to measure the type of investment that you're putting the money into. So, all of these things have to be measured and have to meet certain hurdle rates in terms of return, but also in terms of the impact measurement, which is a very complicated exercise, but Accrescent has been doing this for a number of years now. So that's the format of the financing. It's debt-like financing.
Okay, thanks for that. So a question received was pertaining to, you had mentioned the inventory and receivables financing as part of a new part of growing SCI's scale. Is it that demand has materially increased as evidenced by the impact of supply chain disruptions or other events on those companies?
So there are multiple things driving this, right? I think from about March, April, we began to see, well, let me back up. So we have done a number of, inventory financing transactions in pre-COVID. We actually had a nice little business going there. And then in COVID, we also deployed some capital under that. Then that kind of died down a bit. And then from a receivables financing, all through COVID, we have been kind of piloting a few investments. I think we did maybe 3 or 4 totaling, I would say maybe close to 15 million all in, thereabouts, but ad hoc, right? But from March this year, when we looked at what our partners in the various territories were showing us, we had, I would say, several $100 million in pipeline, but we don't like to talk about pipeline that isn't like executable within, let's say, a 3 to 4 month period, right? So 3 to 4 month period pipeline we're talking about, let's use a very conservative number and say it's substantially above $50 million. In fact, we have one transaction that is more than 50 million that we are looking at the moment to bring to committee. So based on the economic environment, yes, we are seeing a lot more of this, but our inventory financing, is a little bit different from the traditional inventory financing that most people might be thinking about. I don't want to say too much about it for obvious reasons, but let's answer the question by saying we wouldn't be talking about it if we weren't seeing the demand. So we have a very, very large pipeline with some unique situations where we actually have excellent downside protection. So we decided to expand that vehicle, and yeah, our partners who have worked with us, and a matter of fact, almost all of these transactions are from repeat portfolio companies, are repeat customers, so to speak. So we have done transactions with them before. Even the one that we did during the quarter, one that we have done post the quarter, those are repeat customers. The ones that we are looking at now are actually repeat businesses, customers who have, lot more opportunities to show us, and we are partnering with them and working with them. So these partnerships have been built up over the last 5+ years of operating. So we feel very, very confident and good about it.
All right, thanks for that. A question that came in is, could you give some color around what would have contributed to the big increase in interest expense for the Q1?
Excellent question. So I went through that already, but I'll go over it again because it's an important point to note. So if you were to look at the balance sheet, right? If you look at the balance sheet in the MD&A, I'll just look at the balance sheet in the JC report, right? You will see that SCI's debt, I think, if memory serves me right, it would have been about 16 million last September 2021, and now it's about 63 million in September 2022. So the volume of debt has increased, you could call it 3 times, right? So the debt has tripled. And so if your debt tripled, then you mean that your interest expense obviously is going to pretty much triple, which is what you are seeing in the financials in terms of 400,000 versus 1.2 million, right? So the cost of the debt hasn't actually moved, because the cost of the debt now is, I think, 5.8%, and the cost of the debt last year, this time, it was actually, I think, 6%. So if you ask and say yourself, well, how did that occur? Well, because remember that last year, the debt that was on the balance sheet last year, September, would have been there before SCI became a rated company, before we got our first credit rating. Our first credit rating was in September 2021, right? And so if we have debt on the balance sheet in September 2021, that debt would have been raised prior to September 2021. So if we fast forward now to September 2022, all the debt that would have raised between September 2021 and September 2022 would have been in the period when SCI would have gotten its first credit rating. And so because we had a credit rating, it means that the cost of the debt that we raised between September 2021 and 2022, we were able to do so at a cheaper cost of financing. So the cost of the debt actually declined marginally, called it flat, right? I mean, 5.8 versus 6% is neither here nor there. 20 basis point difference. So it's really the increase in the volume of debt utilized. That is what caused the interest expense to jump. Obviously, a large part of that is 22 million or so would have been, what we use to finance the acquisition of Accrescent.
Thanks for that, Jason. Now, on that note, a question that came in was, will the rising interest rates impact SCI's borrowing costs and then funnel through into the interest expense line?
Absolutely, yes. So at the moment, our cost of financing is 5.8%. We are going to be refinancing about 30 plus million in the next 2 or so months or less. That cost probably, when you take that new cost and to try to get a weighted average cost on the overall portfolio, it might rise by about, I don't know, 150 basis points, give or take, right? So our cost of debt might move from, let's say, 5.8% to maybe 600, 6.8, 7.5% thereabouts, right? But so interest expense will go up there. But at the same time, the portfolio is repricing every day, right? So it's repricing by new assets coming on the balance sheet, are repricing obviously higher, because you can see that you can see what the fair value cost yield is. Assets that are maturing or assets that require an extension or whatever is required, those yields are going up all the time. The average the average tenor on the portfolio is 1.7 years, which means that we have 48% of the portfolio maturing in under 1 year, right? So as those mature, when they are replaced, it's gonna be at the prevailing market rate. So the key thing here is to look at the spread, which is, okay, we are putting on assets at, let's say, use a number, 14%, and our interest expense is, let's use a rounded number, is 7.5%, right? So the key thing, our target is to maintain a 500 basis point spread between those two things, between the asset yield and the cost. And at the moment, we are a bit above that. So even when our part of our interest expense reprice is higher, the fact is the spread, as long as the spread doesn't fall below, come anywhere close to 500 basis points, we are good, and we don't expect that to happen based on the type of assets we are putting on. And in addition, remember I told you about the fact that there are new revenue lines that are gonna come through to SCI. So as the business expands and part of your portfolio is generating upfront income, then what's gonna happen is that when you look at your quote unquote IRR, so instead of saying a yield, if you look at the IRR, which is okay, I borrowed $10, I used $5 out of the $10 and put $5 worth of asset on the balance sheet, right? That asset on the balance sheet is at, let's say, 14%, and the cost of the liability, the $5, is at, let's say, 8%, just for simplicity, right? So I have my spread right there. But then the other $5 out of the 10, which is, the liability, the debt, I use that and I fund the transaction and sell it off within, let's say, for simplicity, for simple maths, right? Within 1 month. You realize what's gonna happen there is that the IRR, the return generated, and that second part of the activity I just spoke about, because I'm gonna pay out back that debt, that $5 is gonna I just draw on it and I'm gonna pay it off back. Then what's gonna happen is that it's gonna generate a different type of income, not net interest income. Then I'm gonna generate an upfront income, where when you add net interest income plus that upfront income, then the total spread that you generate on your cost of borrowing is gonna be, substantially enhanced, because you are generating a good amount of income, but you only use the debt for a very short period of time. I hope I explained that and didn't confuse everybody. So basically, there are ways to increase your net margin. So the key thing is not so much whether or not your cost of debt increases or falls. The key thing to focus on is the spread, your margin. What is your margin? Can you maintain your margin? Can you increase your margin? And as long as we are going into a higher interest rate environment, all financing institutions are supposed to make higher margin. The key thing is to ensure that you are doing so in a responsible manner by deploying capital into assets that give you adequate downside protection, so that if things go bad, you don't lose money. That's it.
Yeah, thanks for that explanation, Jason. So there's two questions here that they're tied together. First one being related to the Cayman asset that would have been charged off. Could you state what is your likelihood of recovery in light of the situation, the winding up situation, and could you state where does SCI fall in the ranking of creditors to this institution?
So answer the second question first. We are junior creditors. There's only one senior creditor, which is a bank. With Cayman law, you can't register second charge over asset on a Cayman law. So we are junior creditors. In terms of the first part of the question, what do I think? I give it a low probability of recovering anything substantial. If we do, then we write it back to the income statement. But we are fully provided for it. We were hoping that the refinancing would have gone through. The refinancing didn't go through in the time that was scheduled. It has been wound up, and now we are in the process of the asset being sold and to pay out, I guess first the senior creditor, and whatever is left to pay out the junior creditors. So that's where we are on that. I think that there's a low probability. I prefer to keep a pessimistic view and then be positively surprised. But at the moment, I think that is a low probability.
All right, thanks for that. So one of the questions asked was pertaining to the accelerated growth path of 300 million in the next 3 years. Is there a vision that you see for SCI from an asset-based target perspective, and also how we intend to reach that target?
Well, answer the last question first, how we intend to reach that target is very simple. We first complete the integration of the Puerto Rico business and then expand it significantly, substantially. The pipeline is there, the business is there, the environment is ripe for it. They have an excellent, exceptional track record. They have multiple business lines. They have impact investing, which is a huge thing for US investors. And of course, Puerto Rico is a US territory, it's a 100 billion economy. There are advantageous tax benefits to be had for investing in Puerto Rico by US mainland investors. So that business is clearly going to be a key part of that. But take it back home in terms of SCI excluding Puerto Rico, the relationships that we have built over the last 5 years plus, have been immense. We have built very, very strong relationships with portfolio companies right across the region. We have built very strong relationships with government and sub-government, quasi-government entities across the region. Very strong relationships. We have solved problems that no one else could solve. During the middle of COVID, type of problems that SCI solved for portfolio companies. For those people who went to SYGNUS you'd have heard firsthand from some of those portfolio companies. We solved some problems that no bank, nobody else could solve, right? So these relationships exist. So now what we are focused on is enhancing these relationships with international and multinational relationships, so that we can attract huge pools of investment capital and financing capital. If we are talking about 100 million, 200 million, 300 million, then we need, for example, access to 100 million, 200 million dollars of credit lines or credit facilities that we can tap. The Caribbean private credit market is huge in our estimation. We think that overall, combined, including Puerto Rico, you're looking at 4 or 5 billion US dollar market. If you exclude Puerto Rico and just look at the English and Dutch speaking Caribbean, we think that this is closer to at least a 1.5 billion dollar market. And this excludes things like receivables financing. Receivables financing by itself is a huge market. So what I mean? So we have already laid the foundation, we have laid the track record, we have robust platform and systems that are operating, we have a large team, right across the investment manager you're talking about, 66 employees that are all dedicated to alternative investment. So what we need to do now is just buckle down and access those large pools of capital, one, so that we can, two, start, enter syndication discussions with where, let's say a wind farm needs to be financed, solar energy, large 50 million, 70 million projects that require large pools of capital, that we can be at the table to lead those transactions and put down our capital and affect the Caribbean middle market and medium-sized businesses in a positive way, and also, in a sustainable way. So that's what we need to do. That's what we have been busy doing. We have been visiting many countries. We have scheduled a number of country visits to make, and because we think that private credit we are so still early in the game. As a percentage of bank financing, private credit is a drop in the bucket, is not even 0.1% yet. So we think that this opportunity is huge. We have laid the foundation, and now we need to access those large pools of financing, while working with our local financing partners who have been very good in terms of providing capital. But we have to diversify our sources of financing and go big.
All right, thanks for that, Jason. So a question that came in was that, could you expound further about the new revenue line that you're anticipating for SCI?
I will only expound further when it start to be show up on the income statement, for obvious reasons, right? Don't want to talk too much about our plans, to be honest. But rest assured that everything that we have said to investors from inception, if we say that we are going to do X, we have done X. So we have that track record of being very transparent. The reason why we are on this call with you taking your questions is because of enhanced transparency. So perhaps this is a conversation, that question I can be asked this quarter that I can explain, because it will be on the income statement, perhaps. I'm not sure. But I don't want to say too much, except to say, as we expand the business can't survive on one revenue stream. If we want to grow ROE and push that to double digit, for example, and enhance dividends and get the yield on SCI to increase as we go through time constantly, right? Paying out more dividends and therefore increasing the dividend yield. Then the only way that's going to happen is by having complementary revenue streams to the bread and butter net interest income and net interest income. So we are working on that, but a key part of this is to access those large financing facilities, because that opens the door for SCI to delve into certain business segments that we can't do very efficiently with very small pools of capital, right? So when we have 6 million and 7 million revolving credit line, and if we go and raise 10 and 15 million from the market each time we go in debt, yeah, that's good, but we need to be talking about 50 million and 100 million and 25 million each pop. If we're not talking about that, then the business can't scale. In other words, it's growing at a particular rate. Now we need to scale it, which means that there's a big jump one time and then it grow at a consistent rate at that new higher level. That's what we are pushing to do. And of course, because the balance sheet is so unlevered, right? We are well protected in terms of the current economic environment, because it's not like we have 10 times leverage or 8 times leverage. We are less than 1 time leverage still, and we are trying to push to get above 1.25 times leverage, or perhaps sometime in the future when it benefits us to change the management target leverage metric. Once we can utilize leverage in the manner I just explained, which is you're generating net interest income with part of the leverage, but you're also generating upfront fees or revenues that is not interest income dependent.
Okay, so there's 2 final questions. that came in is one, could you explain what would have contributed to the FX gain during the quarter for SCI?
Good question. So in the audited finance, well, last earnings call, I think I had to go through a lot of pain to explain why we are showing 400. I think we showed 450,000 or 405,000. I don't remember which in FX losses, and I would have explained that. So effectively, SCI has been for maybe the last 6, 7, or 8 quarters net short Jamaican dollars. So we are a US investing company, but we do have some small J dollar exposures. I think maybe 6% of the investments are actually denominated in Jamaican dollars. So what we tend to do is to do asset liability matching. So we basically have Jamaican dollar liabilities that offset the Jamaican dollar assets. So because our Jamaican dollar liabilities are greater than our Jamaican dollar debt, it means that if the exchange rate depreciate, we will see an FX gain, all other things being constant. And if it appreciate, we see an FX loss. So for the quarter, the exchange rate depreciated marginally, I think from 150.9 to like 151 point little bit. So there's a slight depreciation, and because we didn't really conduct that many buy or sell FX transactions, so we didn't crystallize any actual purchases or sales, then whenever you have these type of pair, we'll book unrealized gain. So that's all it is. So if we don't buy or sell any FX, which normally when you buy FX, there's a bidder spread on it. So but if nothing changes, our net, we have a net short position of 4.5%. So if the exchange rate depreciate, we book again. If it appreciate against us, then obviously we suffer a loss, and that's what's generated the gain for the quarter.
All right, and then the final question that came in was similar to SCI's. I think they said the 2018 annual report. Do you intend to start to again break out how the different instruments are for the different portfolios?
That will never be broken out in the future again, for obvious reasons. So my apologies, but whatever you saw in the 2018 report, just take it at face value, that those are the type of instruments that we are utilizing to invest in. But we're not gonna, we're not gonna give away, we're not gonna break those out. Just rest assured that every type of customized financing debt structure that exists on planet Earth, SCI can, and if required, will do it.
All right, so that rounds up all the questions that we have today. I want to say thank you, Jason, for making yourself available to answer these questions from our stakeholders. I want to say thank you to everybody that joined the meeting today. This recording will be on the SYGNUS website for your viewing after, as well as the presentation. And just again, the report would have been released this morning and can be found on the Jamaica Stock Exchange website as well as the SYGNUS website. So thank you again, everyone, for joining, and hope that you have a good rest of the week. And we look forward to seeing and hearing from you soon. Thank you.